earlier this week, an accelerating sell-off in US government bonds spread havoc across financial markets, pushing up borrowing costs, weighing on currencies and driving stocks towards a technical correction. SABC Markets presenter Nastassia Arendse spoke to James Turp, fixed income portfolio manager at Sanlam Investments, about the recent moves in the global bond market.
It really has been quite a sell-off in bond markets, hasn't it? It's been this return to a world of higher interest rates, of higher inflation, that becoming structurally more accepted in global economies at the moment. And as such, we've seen one of the most severe sell-offs in a short period of time in bond markets across the world. And at the moment, it's very difficult to say whether we are at the end or not.
I mean, when you look at this type of move that we're seeing, or rather we did see in bond markets, and let's, tap into your career memory here. Have we seen anything like this before? Any similarities to stuff we've seen in the past, or perhaps even differences?
Yeah, it's a great question. So going back over, say, the last 30 years even, we can see from the 90s how bond yields have gradually moved lower through time, ultimately bottoming out to even negative yields post-COVID, post-global financial crisis. So memorable sell-offs. I think if we go back, we can think of the global financial crisis as a real risk sell-off event, but nowhere near the extent we're seeing now. We can go even further. The taper tension, where the Fed reversed and undid its quantitative easing, was when it was buying bonds to provide liquidity to support the ailing economy. That doesn't compare to this sell-off. Then we can look at another similar event, and that was when President Donald Trump was elected, and global bond markets saw, amongst other things, that to be a signal for the end of globalization and the global economic boom that had been there before, and bond markets sold off. Now we're at a very similar point, perhaps, to the end of that sell-off, which was in December of 2018, and we saw central bank, or rather Federal Reserve Bank Governor then Jerome Powell and President Donald Trump talking at different ends of the table on interest rates, where the Federal Reserve wanted to hike rates another time for inflation, and the president saying we needed economic growth. They hiked rates in December. They then ultimately turned dovish in the beginning of the next year, and from that point, bond yields rallied lower. Now, there's some similar interesting coincidences between then and now. We had everyone at that point calling bond market yields higher. The US 10-year was at about 3.25%, when we even had the head of JP Morgan at the time, Jamie Dimon, saying that the market should be prepared for yields of 4, even 5%. Now, he actually came out the other day saying something exactly copy and paste, saying that we currently should be and aren't prepared for yields of close to 7%. At the time, back in 2019, that was when bond markets turned and ultimately rallied hard down to those post-COVID close to zero, even negative yield levels. Now, at the time, everything seemed bad for bonds, and it did turn. Could we be at that point at the moment? It's very difficult and dangerous to put all eggs in one basket and think that's the case. But certainly, bonds have sold off for the worst I've seen in my career in a short period of time as well. And at the moment, very difficult to say whether it's a turning point now. But as an investor, you can't turn your backs on bonds all the time, and you need to have some in the portfolio.
And as an investor then, given this backdrop that you've just described, how are you positioning? What are you bullish on at this point?
Also a good question. Thanks, Nastassia. So, in fixed income, you do need to be cautious at this point. So we've been a little short duration in bond mandates. We've been preferring the shorter end duration bonds in preference than the longer ones. That's worked out over the course of the year as yield curves have steepened. We maintain that positioning given the funding dynamics of domestic national treasury going into the budget. So we like the yields in bonds. We're cautiously shorter duration, though, than the benchmark. And for our income funds, we've selectively putting bonds in because our yields are significantly higher than where break-even inflation is looking forward. We still have faith in the central bank's ability to control price inflation. And so selectively, we still have bonds in the shorter end of the curve in the portfolios. And as I say, you cannot turn your back on these yields at this point, but you really need to be conservative and cautious in this market.
On that note, before I let you go, what's the investor sentiment towards South Africa's bond market?
Yeah, so there's a lot of moving parts, none more important than the medium-term budget policy that's coming up at the beginning of November. National Treasury needs to cut spending is the message. In the absence of spending cuts, it's not going to be good for bonds ultimately until economic growth returns. So if you can't grow, you must spend less. Those are the dynamics going forward for National Treasury to deal with. We've got to see how that plays out. Ultimately, there are signs of the economy turning. There are positive sentiment around load shedding moving into next year. But for now, spending cuts are required, and implemented measures to get economic growth back on track will help bond markets looking forward.